My name is Tamiko Toland from Cannex, and I'm here today with David Lau from DPL. And David, I'd appreciate if you could introduce yourself a little bit.
Sure. I'm David Lau. I'm the founder and CEO of DPL Financial Partners, and I've spent, 30 years now, getting old, in financial services, doing a lot of what I think are interesting things designed around delivering, better value to consumers, from helping build the nation's first internet bank at TeleBank, through to what people probably know me most for, Jefferson National, and as the COO of Jefferson National for a decade.
Great. So I would love to start with that history, because I think it actually leads very nicely into where you are today. So can you tell me a little bit more about that, and the sort of your product set that you developed there, as well as your experience?
Yeah, so I'll go all the way back to TeleBank because it ties in. And so the notion at TeleBank was, it was pre-internet, hence the name Tele rather than eBank or something like that. And the notion was, can we eliminate a big distribution expense in order to provide better products to the end consumer? And in banking, that big distribution expense was a bank branch. This is, dialing back to, the mid 90s, when ATMs were still relatively new. So eliminating bank branches in order to distribute and sell checking accounts and CDs and all that has a material impact on the pricing and costs of the product. So we thought, if you could go direct to consumer through advertising and do it efficiently, you could provide much better products. And that's thesis has kind of informed my career. So when we got to Jefferson, and the use of technology, but because we're a tech-enabled platform with the internet. So when I got to Jefferson National, I came in not at the start. David Smilo, who had founded the bank, also founded Jefferson National after we had sold the bank to E-Trade. He started a company called Enviva, which you recognize and know, and not many people probably remember, but it was originally a life insurance company trying to use technology again to change pricing for consumers. So back in 2001, David had built a company that could do instant issue underwriting on term life policies, which was incredibly new at that point in time, and lots of carriers are still trying to get to that place here 20 years later. And so with that, I was brought in about 3 years later to look at the annuity business, as David was contemplating buying an annuity business, and also getting into the annuity world to try to think about how do you differentiate and compete in the annuity channel.
Cool. So that actually, raises one of the big issues that we've been looking at for a long time in the annuity business, which is really how to capture the hearts and minds of fee-based advisors. And I've been watching this for a really long time. And frankly, it's always been a space of selling a sort of less crappy variable annuity, because a lot of folks, especially RIAs, they may end up with a client who has a product or a set of products that were sold through commission. They look at that and they say, well, this fee structure doesn't work for me, so I'm just going to move you into something that's less expensive, that's, that functions under the fee-based structure. But that's a replacement, and it's not really drawing people to the appeal of the product itself. So, it's been really, really hard for the industry to break out of this pattern. Like, this has really been the story for a long time. I'd say it's changing now, finally. But, talk about, launching Monument Advisor and what your goals were, because it was in the middle of that environment. And, how well do you think that you met those goals?
Some of them very well, and others, kind of didn't materialize in the same ways I thought when launching it. So, it was first, about, product pricing, and again, that history, let's eliminate how do you differentiate? in the annuity world. We didn't want to try to do it with the latest bell or whistle or feature. It was, let's go back to our heritage. Let's take the commission out. Your commissions are hefty, and we're even heftier than in products, and you can really materially change pricing. We went, as most people know, to a flat fee because, again, there were so many different ways we looked at the business. Number one, a lot of companies, insurance companies, look at assets as their measure. What are they measuring in basis? What are they making in basis points and spread over assets? We looked at it as a product. What is the profitability of an account? Rather than the dollars in the account. So that was number one. That's what really enabled us to bring in the flat fee pricing. It costs you the same to open a policy, whether it's $1 million or $100,000, and the cost of administering it is the same. So why do you need this variable pricing? And it's because of the way most insurance companies, manage their profitability. They do it against assets rather than the profitability of an account. So that was number one. That was different. And so that enabled, some pretty, dramatic and notable, pricing differences in the way we brought the product to market. So that was great, from a marketing and distribution point of view to have that differentiation, but it made complete business sense as well. If you're managing your business based on, the profitability of an account. Then the next thing was we had bought, as you know, Tamiko, the business from Conseco, and it was, Jefferson National was the carrier. It was a, $2 billion annuity block that we purchased, and it came with people. We got the policies, but we also got people who came with it who had been working in the business. A number of them had been wholesalers. So, they'd been, traditional wholesalers, face-to-face meetings, et cetera, et cetera. And, being relatively new into the insurance world at that point in time, I kind of rolled with that. Let's see what happens as we roll out, this product into an RIA channel, because that's the channel I identified that we'd focus on. Because if you're taking the commission out, you're going to eliminate a bunch of your traditional distribution. So let's find new distribution. And the RIA channel was the channel I identified we'd focus on. And very quickly, you realize that a wholesaling model is not going to work. And that's part of the problem that traditional carriers have always had, is the way they distribute product is through wholesaling. And that's evolving a little bit here lately. But in the RIA world, that's not going to work. And let's define the traditional wholesaling model. The traditional wholesaling model is basically, there's even quotas for wholesalers at most carriers. How many times do you need to be in somebody's office per month? You might have an office that you need to be there every 3 weeks, to make sure you're keeping your name and your face and your product, front and center. That's simply not going to happen in an RIA firm. You're going to be lucky to get one face-to-face appointment at an RIA firm. They want to understand what you're offering. They want to understand, how the products work, et cetera. But they certainly don't want you coming into their office every 3 weeks. And so that was one of the first big changes, was to say, okay, this distribution model, not only the traditional pricing is problematic for this channel, but also the distribution model is problematic for this channel. So I got rid of all the wholesalers, and what was considered a pretty risky and controversial, move, even internally. But, I felt really strongly about it for a number of reasons. One, you were quickly seeing that getting appointments at RIA firms wasn't going to be happening in the same traditional way. Two, my heritage is in, direct marketing. And, that's, I'm a marketer, and I've built my, career also on marketing. And so I knew we could be a heck of a lot more efficient. We could reach a lot more advisors, through a centralized model, marketing out to them with education and information, and then giving them a resource to talk to when necessary. So those were a bunch of the pieces that, we re-engineered, relative to the pricing and distribution of annuities.
So it makes a ton of sense, especially from the cost perspective. I mean, that traditional wholesaling model does not fit with it's the thing about monument advisors. It goes beyond fee-based, right? because it's not an AUM based model at all, actually, for the
Yep.
carrier. I mean, it still is for the RIA, and I always like push back a little bit on this, that you're still paying for advice. You're still paying for a person to be there. It's just coming out really differently. But Monument Advisor actually cuts that down even more. So, I guess, do you feel that you ended up at the right place when it came to your adjustments to wholesaling?
100%, in the right place in the adjustments to wholesaling. I mean, we still employ that, same model here at DPL. The face-to-face wholesaling is simply not efficient. It's too expensive, and it doesn't work for this channel. RIAs, again, they don't want to see somebody, every 3 weeks. So, we do a very limited hybrid, where, we'll try to, blend in some face-to-face if we happen to be at a conference in somebody's geography or something like that. But I think it's, it's still 100%, the correct model, for this channel. Getting back to some of the other part of the question that I guess I didn't get to is like what worked out and what didn't, in my mind. So when I built the product, we were studying the market. It was, what do RAs do? We're literally learning the market, and they manage assets, and they use Schwab as a custodian. And Schwab, I think, had 80% market share as a custody platform, back then, because this is 2004. And so the notion, around the product was, okay, what's the benefit? You talked about the way a lot of advisors used it was, low cost replacement. But what were we really building? We weren't really building a low cost replacement, for existing variable annuities. What I was building was Schwab OneSource, which is their mutual fund platform, with tax deferral. So, if they're going to manage mutual funds and do it on Schwab, let's do the best that we can to replicate that and basically say for $20 a month, we're going to give you tax deferral, which is a really valuable thing. And I think, that's the aspect that, that dynamic is what came out differently, than, I had originally, drawn up. It turned out to be much more of a, low cost, let's get my client out of this expensive annuity into something that's, far less expensive, and less so about the tax deferral. Though we did have advisors who used it for tax deferral in the way, I kind of designed it for, I would say, not nearly as many as, I had originally planned.
Yeah, well, I think the tax system also has sort of shifted that entire value proposition. I mean, that's one of the reasons that we've seen the evolution of all these other secondary guarantees. It's because the tax deferral element gets slimmer and slimmer and slimmer. And now, with capital gains at like such a low rate, obviously we don't expect it to stay there, but that's actually not great for the tax deferral story. So that makes a lot of sense to me.
Yeah. I mean, in some ways it was, dialing the product back to the future, in some ways. It's like, that's what it was originally. The variable annuity was originally built to be this, tax deferred, platform. And then ultimately, in order to differentiate, carriers started introducing, other features and riders.
Yeah, for sure. So, getting back to when I was a reporter and reporting on Jefferson National, and, there were people that were very dubious about what you guys were doing from a cost perspective and what have you. And I often myself really leaned into the fact that you guys had this really great admin system. It was super cheap. It was, you were able to do like end-to-end pure electronic processing, which, still is, it's a challenge, right? To convert everybody over there. And that's what made the Conseco acquisition work.
That's right.
At least like I certainly bought that myself as, say, okay, that makes sense to me. So how does my perception of the firm match yours or differ?
No, I mean, you're 100% right. And I think that's something that, really a lot of people overlook relative to, Jefferson National and what we build. because everybody focused on the product because the product was innovative. But it was really enabled by a low cost structure on the back end, right?
Yeah.
So, and the biggest driver of that low cost structure was the technology. I mean, the technology was, unprecedented and, extremely efficient, and the product was filed electronically, right? So, it was electronically issued. We got rid of lots of paper. I mean, we'd benchmark ourselves a lot on, on our costs, because we were always looking to drive down costs in, opening policies, administering policies, et cetera. And we'd benchmark ourselves, against, some Deloitte studies that looked at other carriers who had far more scale. And it's like, wow, we're way more efficient than these guys, and we're small. And it was really, driven by the fact that, they've got, terrible technology and a lot of people driven systems, and we had modern technology. And so even compared to very large carriers who you would assume would have a lot more scale and efficiency in operations, we were massively more more efficient from a cost basis in terms of opening policies in particular. That's a big one. Costs, typical carrier in eye-popping amount to open an account. And then the ongoing administration, which we completely enabled the advisor to do pretty much anything they needed to do online. And that, to my surprise, was pretty unique in the insurance industry. No longer surprising, but certainly surprising at the time.
It's funny because I remember thinking, well, this is an insurance company that sort of accidentally become an admin system. Like you could have just sold the admin system. I mean, converting the policies over is tough, but I mean, you made it work with Conseco. It was funny because I was like, oh, I don't think this is what they meant to do, but this is what they have done because of so many deficiencies elsewhere.
Yes, and that was, I mean, it was actually pretty interesting. The firm we used, I like to tell this because it's funny. I mean, the firm we used, to help build the admin system, which was a system we built originally, or bought originally, because it was a life insurance system, because Inviva was a life insurance company. We completely built out the variable annuity functionality from scratch using a Jamaican development team, right? It was, it was a small firm based in Jamaica who had built the SPIAS platform that, had gone away, and we used them to build out the whole variable annuity platform. And, it was pretty funny. We did actually at times look into getting into the admin, business because of the efficiency of that platform. But, the conversion's probably a lot easier these days, but, conversion's always terribly difficult, and it wasn't our core competency in looking at converting blocks, so we didn't really want to do it.
Yeah, that makes sense. But I'm really happy I finally got to hear the story of the bobsled team of
That's
the variable
right.
annuity world. So that's fantastic.
Yes, they're terrific.
Yeah. So, on the other side of things, I always saw that your credit rating was really an impediment. It was your greatest weakness, and it kept you from potentially doing other things that, I guess to me that was it was a limitation, but, like, how do you see that, and how would you have built products differently if you didn't have that restriction?
Yeah, so just to level set for anyone who didn't pay attention, we were, at times, right after 2008, I mean, we were a B- credit rating on a negative watch, and still kind of flourishing in distribution, which is a pretty big hamper when you're looking at it. I mean, I think AM Best was being kind, I think, as they were to a number of people at that time, but it really limited what we could do. And most RIAs didn't care because we weren't offering guarantees. And I think this is what your question's ultimately getting to. We weren't offering guarantees. Everything was a separate account. If something happened to, the company, it's fine. I mean, their clients' assets are being held at, the mutual fund companies, not with, Jefferson National so much. So that was, it was a bit of a problem, as we look to expand into broker dealers and things like that, where, you had to have a minimum credit rating, to kind of get on the shelf at, the broker dealer. So I don't know if you remember this, but in order to try to attack that problem, we structured a deal with Phoenix. And so we were going to basically issue Monument Advisor on Phoenix's paper to get their A rating, and spent a lot of time. And I met some great people at Phoenix, Jack Sherry and Phil Polkinghorn, that I'm still in touch with through that deal. But literally like 5 minutes after we signed the deal, their credit rating plummeted, and we never really got to take advantage of that structure. But ultimately the credit rating rebounded a little bit as we raised some capital, and the some of our assets recovered as many folks did, and but still we were a B carrier. Ultimately maybe got to B plus before I left.
You
But
can't offer a living benefit on that.
You can't do anything. You can't do anything on that. I laugh when now at DPL, when a lot of these RIAs start asking us about the solvency of the companies that we deal with, and we deal with massive A+ rated companies. I'm like, do you know that we had about $32 million on our balance sheet at Jefferson National, and you never had a problem with that? We're talking about companies who've got hundreds of billions of dollars on their balance sheet. We had $32 million on our balance sheet. Nobody seemed to have those questions. But to your point, we couldn't do anything else, right? The separate account product, that's what we could launch. So it all plays in together, like a little bit necessity is the mother of invention. Plus, the way I was identifying the market, it seemed like this is going to be a great way to go into the market. Works for the market, works for the company. But as a result, we wound up having a lot of success with that product, and so I think the rest of the industry, who, as you were pointing out earlier, was always looking to get into this RIA market, thought, oh, the investment only variable annuity is the way into the market. And it's like, well, it's actually not. I think it's just the only thing we could do, right? So we couldn't offer guaranteed. We couldn't even offer a fixed account, right? So that's all parts of the problem. So as I've built DPL, that's part of the message. I've worked with carriers deeply for the last 7 years. They're like, isn't it just about investment only variable annuity? It's like, no, it's not just about investment only variable annuity. It's about modernizing your product into a cost structure, meaning eliminating commissions, that works within an RIA's business model. That's the key to the whole thing. Then you can start figuring out all kinds of different products, but you have to build them in a way that they can be used. So it's not just because it's an investment only variable annuity. I think that is already showing itself within what our advisors use at DPL. When we first launched, it was all about investment only variable annuities and term life. Today, most of the products used by the RIAs we work with have income guarantees.
So how do you think that history has actually been a hindrance in terms of people really seeing the vision that you have right now? Because it's definitely a movement away from that. Yet we're anchored on that Iowa story.
Yep. Yeah. So I think it's because and we'll talk a little bit about your survey results. But I think the product, the Iowa, was the only thing available to RIAs. So one, since that was the only thing we could do, our messaging was a lot, around that, at Jefferson National. But the study around annuities have always been good products, right? The fundamental structure of an annuity is a good one. The problem is, like a lot of things, they get, you can lose that value for different reasons. And I think one of the big things that drives the reduction of value of the product is the commission. And, that to me has always been a consistent message of mine, is relative to, throughout my career, even in banking, it's about let's take cost out of the product to provide a better product. Like we were talking about earlier, when you look at tax deferral, the fundamental value of the product, right? Tax deferral. if the product costs 140 basis points, which is about what a commission variable annuity does, the value of tax deferral is almost none. Because it's eaten up by the cost of the product, which is why we thought, at a $20 a month product, you could actually reap the benefit of tax deferral, which we thought was a great new message, and it still is, and probably coming back now.
So the interesting thing though is, like, let's get back to the fact that everybody should get paid for the work that they do, right? And so
Sure.
if it's a commission model, then the amount you're paid comes from inside the product. And so let's say you slice off that 100 basis points and you pull it outside of the product, right?
Yep.
And then, then you have something that's more efficient. And looking at tax deferral, the difference between those two value propositions is not as different. But now when you're talking about income, if you're layering a GLWB on top of a variable annuity, and then you're pulling the 100 basis points out, and then the cost of that comes from other assets. I mean, there's some flexibility often in how that can look, but that seems like actually a substantively different value proposition potentially for the client. And I don't know if that's part of the conversation, but like, to me, when you look at the income potential, like, yeah, that does look really different.
Yeah, that's something people ask about a lot, and I've got some pretty strong opinions about it. Number one, commissions and fees are completely different things. I mean, the only similarity is they're forms of advisor compensation, and one is really broker conversation, not advisor. I know there's nuance around the regulation of who can call themselves an advisor, but one is a broker conversation and one is an advisor compensation. A commission brings no benefit to the end consumer. The commission only costs them, right? So a commission is a sales compensation being paid by a product company to a salesman, regardless of what industry you're talking about. That's what a commission is. The fee, whether it reduces benefit to the product or not, is an optional payment by the client for financial advice, right? So they're very different things, and there's all kinds of study. David Blanchett's got a terrific white paper called Alpha, Beta, Now Gamma on the value of financial advice. So there's real value to the consumer in financial advice. So if you're just looking at the pricing of the product, which is what you should be doing, the price of a commission product, as you said, is usually 100 basis points, sometimes more expensive than a fee-based, than a commission-free product. So product to product, there's no comparison. The fee product is a better product, by a lot. Just like in the mutual fund world, when you're looking at funds that are institutional share class as opposed to ones who have 12B1s, the institutional share class is always a better priced product. So when you look at annuities, it's still the same thing. It's for the client is, do you want to pay that optional fee for financial advice on the product? And you can, by the way, stop it at any time. You can, the day after you get your financial advice, you can tell the advisor, I don't want to pay you anymore, and your costs have gone away. In an annuity, the cost is always there in a commission product for as long as you own it. It's not like the commission, the price of the product goes down after the commission's been recouped. The price of the product stays the same.
Yeah, although that actually has been a thing, right? The B2C. Anyway, so
Yep.
I don't want to get distracted by old products.
Yep.
We've seen a ton of change over time, but I think the most dramatic change has really been with the pandemic. So how do you see that changing the landscape for financial professionals and RIAs in particular?
In some ways, it's been a bad effect, right? Because let's think about the market for the last 13 years. It's been basically up, right? It's up and to the right. It's a beautiful thing. And then so you have a lot of advisors, in any channel who've never really experienced a down market. And then the pandemic comes along, and basically we have a 30% down market that lasts like 3 months. So you're like, oh, the market will rebound easily. Like, this is what I've always been told. The market always comes back. And the fact that it came back so fast, as opposed to, 2008, where, it took a few years, for it to get back to the levels that it dropped to. It's almost a bad thing. It's like, I feel emboldened, again, relative to, the products we're talking about and protection and things like that. It's almost like, what do I need protection for? Market always comes back. And just like we saw in the pandemic. So it's been a little bit of, I think in some ways hurt. In other ways, as we try to point out is, the market is not always going to go up, right? So I think a lot of, again, for many advisors and asset managers, a 13-year bull masks a lot of problems. Everybody, I liken it back, I was in the internet bubble, right? I liken it back to then. I mean, the, E-Trades and, Ameritrades of the world, were booming because everybody thought they could manage their own assets because it's simple. You just, throw a dart at the board, hit a .com company, and you're going to make a fortune, until you didn't. Right. And until the market really crashed and everybody lost money. And it's like, actually, this is a little more complicated than I was giving it credit for. And so I think this long, prolonged market of the market going up and up and up, augmented by the fact that, we had a market crash that lasted only months before it, completely recovered and has gone well beyond the, pre-pandemic, numbers at this point, make it, to me, a lot like reminiscent of 1999, 2000, where, you're masking a lot of issues before something happens, and something inevitably will happen.
Yeah, and we've seen that with consumers, but it's interesting. It's almost like negative economic scarring, where they think, oh yeah, it'll just come right back up again, and it creates this, I think, an unearned confidence in the recovery of the markets. So, you were already you do rely pretty heavily on a low touch model. So how have you seen things change during the pandemic? Have you noticed greater adoption, or is it really just you're already targeting the folks that were leaning that direction anyway?
Yeah, no, I think there's we probably, like every business, there have been good things and bad things, relative to the change in the way you do business today. So, like you said, we've always had, I wouldn't call it a low touch, but I'd say it's, it's a remote, business model. Though, we talk to our advisors, frequently. It's just not face to face. So in many ways, what we're doing here, the video meeting, which has now become the bane of many people's existence, it's that love-hate relationship with the Zoom call, has been tremendously helpful. And something like I'd always wished we could get more advisors to adopt, because we had this model. Now, hey, this accelerated the adoption of this kind of technology, and that's been terrific. But I also think that the face-to-face is still important and would be helpful. We always valued the face-to-face, just not in the same way as traditional distribution. We'd like to get out to conferences. I mean, in 2019, DPL, we went to something like 52 or 54 conferences and events, because it is a good way of getting out there, seeing people face to face, spreading the word, about what we're doing, and all that went away. So that's been challenging, but in general, I think it's helped the business model. And then as we come back to, more normalized times, and we can start doing those, face-to-face events again, and then have the benefit of, the Zoom call to augment that, I think, should be, pretty good for our business model.
Yeah, that makes sense. So now, you've been reaching RIAs for a really long time. And the annuity industry has been trying to crack this market for a gazillion years, right?
Mm-hmm.
So what do you think has changed now, if anything?
Yeah, I think there's a lot of things that change, which is what caused me to launch DPL. So, number one, in 2004, when I was first looking at the RIA market, at Jefferson National, or in Viva to soon become Jefferson National, RIAs were primarily just asset managers, right? They managed people's money. That's what they did. And so the RIA market itself, and it was relatively still small niche market. I think it was, 500 billion in combined AUM at the time. It's, 6 trillion or so now. So it's been growing massively. But it was still kind of a cottage industry. It was, asset managers who custodied assets at Schwab, and, a lot of, individual practitioners, certainly, very few firms with multi-office, locations. And now we see all the ways that's evolving, right? You're getting these mega national firms, all this consolidation. And all during this time, the industry's moved from being asset managers to being financial planners. Financial planning has gotten huge. Everybody is working off a financial plan now. Some will, in fancy ways call themselves wealth managers. And all of that now involves insurance. At the same time as the RA market's been evolving, the rest of the world's also been evolving, right? So the transactional based broker at a wirehouse or a broker dealer is also going away. Most of those advisors are now managing assets on fees. And the way I tell advisors is, RIAs, your model has been so successful, everybody is adopting it. And by the way, they're instead of being fiduciaries, are acting in a client's best interest. So your historical points of differentiation for an RIA have basically gone away. Everybody's managing money on fees. They're sitting on the same side of the table in the vernacular, and they're acting in the best interest. So if you're an RIA and you're not providing financial planning and wealth management and providing insurance, then you're at a competitive disadvantage to pretty much everybody else in the market. And so I think that's, one thing, and you see it in our business, in a way of a proxy of the way the RIA market is evolving. We have a membership model, as you know, so RIAs join DPL as a member. So in our world, we think about that decision being made by somebody above the line, somebody who cares about the business and the profitability at the firm, not somebody who's necessarily the asset manager or the financial planner. Because the business people get, from a business point of view, not providing insurance to their clients is a bad idea. Right? It's a bad idea because it's business 101 to let's get more wallet share from existing customers, because it's way more efficient than having to go find new customers all the time in order to grow. So if you can grow your wallet share from your existing customers, by, providing, another service that fits right into your business model, fantastic. And the other thing is that if you're now doing financial planning and you're identifying insurance needs, even if it's just term life, you don't want to be sending your client to a competitor to get it. And those people, as I was just talking about, are more and more competitive with you every day. So from a business point of view, makes complete sense. So we've seen our membership, grow like crazy. For 3 years, we have probably one of the bigger RIA footprints of any firm in the industry. With about 1,300 firms that we work with on a membership basis. Then the product sales come a little slower, right? Because now you get it from the business point of view. Now we have to turn all these, asset managers. Hey, you can now use these products. Let us show you how to use them. So we do a lot of education and showing people how to use products and how to build them into plans and all that stuff. So it's a little bit slower on the distribution side, but that's ramping up super fast as well.
Sure. And that comes as no surprise, but it's interesting that there is that transition of a certain segment of folks getting it as a business proposition, but then like kind of getting religion about it and being able to adopt it and be comfortable is another thing. So we are partnering with the Alliance for Lifetime Income now to do research, and we have this new survey, and we've kind of taken a different approach where we are asking questions really from a top-down perspective in terms of, we, for both financial professionals and consumers, but really trying to understand the array of financial professionals and how they're working with their clients, what kinds of strategies they're using, and then eventually asking about the implementation of annuities specifically. But, coming from the perspective of the concept of protection, So we include quite a bit of RIAs in the survey. And I think that there's not a ton of surprises, but it definitely reveals places where there are these educational opportunities. And so I just, we can chat about some of these things. But one of them is how important is the concept of protection with retirement income with their clients. And, the interesting thing is that, so for investors, so this is like very important, it's like the highest level. Investors say like 55% of investors think that it's very important. Overall, for all financial professionals, it averages out to 39%, but for RIAs only, it's only 26%. So, I mean, aside from the fact that, yes, it's not surprising that it's less than it is for other financial professionals, it shows that it's really significant gap conceptually between what investors think is important for retirement income planning versus how RIAs see it. And I mean, is this more the types of clients that they have, or like, talk to me what you think?
Yeah, I think there's a lot to that. And I would tell you, in my opinion, that even the other channels, advisory channels, underestimate what consumers want. And that's a bit of an evolution. And then obviously the RAs are even further behind. And I mean, I think it's, pretty apparent why that would be, is they've never been able to use protection products. So they have to sell against protection products, and they are asset managers. They believe in their ability to manage risk through diversification, of assets and being really good asset managers. But the thing that I think advisors across most channels haven't caught up to completely yet is the fact that retirement is different. Because literally 15 years ago, retirement, funding a safe retirement wasn't a very big problem. Frankly, it was pretty easy. You had robust interest rates. So now we've had this confluence of events. It's almost like a perfect storm of problems for a retiree. If you can call life expectancy getting longer a problem, it is financially, right? But I mean, happy development for most people. You've got life expectancy growing so that retirement is now 30, 35 years, for a lot of people. Interest rates that are historically low. And in a traditional investment world, those are the bonds are the safe asset that you're allocating to for a retiree who's going to, clip coupons to fund their retirement spending, from bonds. And they were doing it for, a 15-year period, a 20-year period, just a few years ago, or thinking about it in that way. So I think you're seeing these things happening where retirement was never that much of a problem. And you also had pensions and things like that, by the way, to, provide additional, secure income, which, is very rare outside of government sectors these days. So you have a relatively new problem, a really low interest rate environment where clients are going to have to self-fund a 30-year period, which is probably a third of their life, where they're self-funding. So I think the importance of annuities and secure income is felt more immediately by the consumer, secondarily by the advisor who has been doing things a certain way for so long. It takes them a little time to, catch up to the lag of, what the realities are. But I would tell you that, relative to, consumer opinion, advisors across all channels are lagging that security concern.
I think that's very true. And, the other thing is just overall capital market assumptions. I mean, the expectations on equity returns, those are also adjusted. And so the entire equation of that buildup and then decumulation, it doesn't work the way it used to work. And,
That's right.
I think that is going to take a little while, because we also asked a question about whether you had changed your investment strategy or investment, whatever, planning strategy due to factors in the pandemic. We have a bunch of different factors. So did you change moderately or a great deal? And overall, the number is 23%, which is, it's a good percentage, yet it feels like it could or should be higher overall. But for RIAs, it's only 11%. And so it's a very small chunk of them that looked at all these things and said, oh, I need to do something differently, which is a little bit alarming, because we're talking about some very substantive changes. But the things that influenced them the most, like the reasons that they were most likely to change were low interest rates and then low bond returns. So I guess
Yes,
that should probably
which
come
kind of tied
as no
together.
surprise to you, right?
Yep. Yeah. And I mean, and so again, you're looking at a market that fundamentally believes in the markets, right? That the
Mhm.
markets, the markets go through these cycles, the markets have ups and downs. You manage the volatility of the market. You have a long view of what's going on in the market, and what your expectations should be. You don't worry, on the short term. I mean, that's the general, thought process, of the, RIA investment advisor. So I would say that I think the research is right. I mean, I don't think the pandemic should have been changing much of what you do. And again, kind of reinforced by the fact of how fast it came back. But I think the low interest rate environment, and I wouldn't say that's pandemic related. That may have been exacerbated a little bit by the pandemic, but this has been a trend for 13 years also, right? While the market's been going up, interest rates have been going down. And I think that is the reason you should be changing the way you're thinking about managing assets. Not so much about the pandemic, because that was a blip.
So anecdotally, do you see the messages on interest rates and, like replacing fixed income with annuity products, or trying to replicate, say, bond ladders through income? Like, are those messages really resonating more now, do you think?
Absolutely. Absolutely. And again, it's related in the way we talk to, firms, about low interest rates, pandemic, not a factor, and it should, for a couple of reasons. One, because it's the yin and the yang, right? I mean, you've got the obvious low interest rates. What do you do with the assets you've been investing in, those kind of bonds or bond ladders where they don't yield? And going back to market assumptions, many market assumptions now are, for the next 10 years you're going to have negative real returns in fixed income. That's problematic to not only to a portfolio, but to an advisor's business model. How do you throw a 1% fee on that, right, and make it even
Yeah.
worse? It becomes problematic. But I think that low interest rate environment, the other side of it. So looking at annuities for accumulation, as well, as looking at MIGAs, multi-year guaranteed annuities, or fixed indexed annuities for an allocation from that fixed income portfolio. We've seen a tremendous amount of that, and that's we focus a lot on that and the education around that. But the other side of it is you're also taking on more risk in the equity markets, because one, for the advisor, it's hard to move the money into a bond that's not going to perform, and for their clients, they don't want to see it. They're like, okay, the market's been doing great, why am I going to take money out of the market, and look how fast it rebounded.
Yeah.
Why am I taking money out of the market to put it into a bond that's not yielding anything? So I think you have a real problem in that. So I think some of the protection factors of like RILAs, the buffered annuities, where you can still have equity-like exposure and some level of downside protection, knowing as an advisor, as an asset manager, that you're keeping more money in the equity portion, it makes sense to at least de-risk some of it, with an annuity, that can provide some kind of downside, benefit, downside protection. And so we've been messaging that a lot as well, and we're seeing the uptake in those products accelerate.
Yeah, that makes a lot of sense, and particularly what you're saying about the desire to stay in equity, as opposed to just sort of pushing people. It's like, no, you need to invest in something you're not comfortable with. That seems to
Right.
bridge the gap a little bit more nicely, for some folks. So, I could chat with you about this stuff all day.
I know.
I know, but I'd like to wrap it up, but I want to ask you a couple of questions. First, would you be willing to share with me any of your annuity pet peeves?
Annuity pet peeves. Oh my goodness. There are loads of them. Complexity is probably the biggest one. My biggest one is complexity, and not in the way that a lot of people think about it. Because ultimately, I don't think they're very complex products. I mean, I think that's an unfair knock that annuities get. A mutual fund to me is a hell of a lot more complicated than an annuity. I mean, if you want to talk about, explain to me how my mutual fund return is calculated. You're gonna need a computer and a powerful spreadsheet and loads of assumptions to explain that. You don't need that necessarily in an annuity. So, but I think the complexity in terms of bringing in riders with different nuances and things like that, which to me are unnecessary. The products, again, fundamentally are good products. Let's just have variable annuity products that have accumulation benefits, maybe some kind of downside protection rider if somebody's interested, but accumulate tax deferred, using funds, turn it into income, at that, later in a client's life, when they're ready for income. Or you've got fixed products. Let's just simply accumulate on a fixed basis, whether it's through an index or, a fixed account, and turn it into income. Keep them super simple. Build products in the way I talk about it, build products that can be used, not sold. And products still are too often built to be sold and not used. And I think that's fundamentally a problem, and that's what's got to change in the annuity market, for all kinds of reasons. We won't even get into all the problems with illustrations and things like that in the way products get constructed. But it's the complexity and the ultimately building products to be sold, not used.
Cool. Okay. Did you want to add any other pet peeves? That was a good one.
Oh my goodness. That's a good one. On the flip side is, part of what I was talking about. Some of the misconceptions about annuities are pet peeves to me. It's I don't know if this would fall under your umbrella, if this is fair, but it's the pet peeves about the misconceptions. We do surveys here, as well, with advisors, and it's stunning the number of advisors who claim they're knowledgeable about annuities who have no idea that you can, generate income through a rider. They only think about annuitization. And so when you ask, and I think we talked about this before, actually, Tamiko, the fact that an annuity isn't a single thing. And, often when I talk to, RIAs about annuities, they describe to me some kind of Frankenstein-like product that is this, combination of all the bad things about different kinds of annuities. Well, they're illiquid. Well, no, they're not. I mean, some are, but, not all annuities are illiquid. We've got plenty of variable annuities with no surrender, completely liquid, or even, fixed products that have market MVAs on it, so market value adjustments, which work just like a bond. So that's those kind of misperceptions are also annuities. They're complex, which I already talked about as a misperception. The fact that they're all illiquid, that you're turning your assets over to the carriers. What if you die the next day? I mean, these are can all be addressed either through product options or different products, and that drives me nuts when people have extremely strong opinions built upon bad information.
Yeah, everybody's worried about getting hit by that bus.
Yeah, exactly. And everybody talks about, no, we'll get to another one. Everybody talks about my SPIAS. Everybody talks about SPIAS. Everybody wants to talk about SPIAS, single premium immediate annuity, right? The immediate income annuity. And the fact is, very few people use them. People don't like them. They're conceptually great, but you have to have the right mentality as the consumer to be able to use them. Variable annuities, fixed indexed annuities are far more popular. Let's talk about those products. We can also talk about SPIAS, but it doesn't need to always be about SPIAS.
Yeah, you don't have to pander to me because I do love SPIAS. We love SPIAS, but
yes. Yeah,
so,
they're academically beautiful products, but
great products.
most people don't like them. So,
but there are a lot of great products. There are a lot of great, there are a lot of great solutions out there. So let's
totally
leave it at that. So tell me, what, if anything, do you miss about the industry from the past?
If I think about it, I think about, the RIA industry, a little bit as well. I miss a little bit of that, cottage industry nature. talking to, a lot of the old time original, RIAs. These are, characters. They've been, characters, and I mean, I consider myself an entrepreneurial guy. They're entrepreneurs, they're risk takers. They got into the business when, like, it wasn't such a proven model. I'm talking about people who got into the RA business in the 80s and 90s, and when it was totally different, and they're taking a risk. And I think you're starting to miss some of those characters. It's getting to be a lot more corporate. There, like I talked about earlier, there's lots of M&A and roll-up activities, et cetera, et cetera. And for better or worse, a lot of companies are acting more like businesses than some guy's asset management shop. I miss a little bit of that for sure, but like I said, there's good and bad to that, kind of increasing professionalism that's come into it as well.
That benefits your business. You may miss the characters,
right?
So you got to find a way to get the characters back in, but then still have these things run like businesses.
That's right.
So what are you looking forward to in the future?
I look forward to, relative to, to what we're doing specifically, that, and not only relative to what we're doing, but like continued education of the advisory industry in general. It's a transition, and it's one of the things that, I'm very passionate about is retirement. Again, as I was talking about earlier, retirement is a relatively new problem, and still most advisors focus on accumulation and building wealth because it's a sexier story. I'm going to make you more money. I'm going to invest your assets so smartly, blah, blah, blah. And if we're all being honest, that's kind of been commoditized, right? I mean, I laugh because most people will tell you, what should I do on the accumulation side? Buy low cost index funds and buy and hold, right? I mean, have, some actively managed funds, maybe an international or something like that, but buy and hold, be out there for the long. Okay, so we're done with that. Now what? It rebalance it occasionally. I mean, that's basically the prudent, academically driven advice. But retirement is super complicated, and I really look forward to when there are more advisors who are focused on retirement and are expert in retirement and are not simply taking accumulation strategies and trying to apply them to, to retirement, because it doesn't work anymore, right? It's fine when you had a 15-year retirement and, really high interest rates, but retirement is a problem. I think too many advisors, regardless of the channel, are a little too, nonchalant about it. This is a very important time, for, end clients. They're at total risk. They don't have, they're dependent on their financial advisors. They don't have the remedies they had when they were accumulating to decide to work longer or save more, or these things. They're dependent on the nest egg that they built while they were working and in their working days. And so you need to be, as an advisor, more cognizant of what your client's mental and psychological needs are in retirement, and you need to focus different strategies. Like I said, if you ever tried to hammer in a nail with a screwdriver, you might be able to get the job done, but it's not a good way. Grab a hammer, right? I mean, to bang in a nail. So use annuities for income. That's what they were built for. In addition to tax deferred accumulation, trying to use a portfolio to generate income is using products for a purpose they weren't designed for. So I really look forward to advisors kind of catching up with the consumer needs, as shown in your surveys, of what consumers are looking for, adapting their strategies to deliver to consumers what they're looking for in retirement, not just saying, hey, I'm an investment guy, we're going to use investments to fund your retirement, come what may. So that's what I'm looking forward to.
I can't argue with that. Like, woohoo, retirement.
Yes, it's such a big problem. It's such a big problem. And I've always tried to be on the side of the consumer in everything I do, thinking about, the consumer. And again, I just think about these retirees who are so vulnerable and reliant upon the financial advisor. And I think to be, flippant about how I'm going to manage your assets, and I hate annuities, or I'm not worried about risk. It's like, hey, that's easy for you not to be worried about risk, because or one of my favorites is, I'm just going to manage your spending. That's a very popular one, in the RIA channel. It's like, oh, plans, financial plans won't fail because we'll just moderate spending. It's like, one, consumers don't want that. Two, you can't do it. I mean, you might be able to do it, but you certainly can't say that you're going to be able to do it for sure. So file that under the pet peeve, something I'm looking forward to, whatever. but that one I had to get out there too.
Oh, good. No, that's fair. I mean, I think it's really unfair for somebody, a professional, to come along and say, what, I'm sorry, but you can't pay for that insulin this month. It's just,
sure.
It's not in the budget. So that's the thing that's going to get cut.
Yeah.
I mean, that doesn't really work great.
No, it's a very advisor-centric mentality, not a client-centric mentality of, I want you to be dependent on me to tell you what you can do and where you can do it, and to manage your assets and your spending. It's a very, self-centered, point of view, rather than a client-centric point of view of, why don't you ask the client what they want? That'd be pretty novel. Ask the client what they think is their best interest.
Yeah, absolutely.